use the fair value option. All right, so we're going to sell 3 different types of, we're going to go through all 5 categories with 3 different activities. This activity is going to take care of selling our debt investments. So generally, the process is the same for every investment that we're going to sell. So it's going to be these 3 steps. We're going to make any adjustment necessary to bring the investment to fair value. The second step, this only applies to the available for sale because we recorded those unrealized gains and losses in OCI. When we actually sell the investment, we've got to reverse those things out of OCI so that all of the gain goes to the income statement. And so we don't just leave things in OCI that we don't even have on our books anymore. The third step is to record the sale and remove the general ledger accounts. All right, so we have our bond information. And then the activity says basically make the entries for this available for sale. Okay. All right, so the first entry was to bring it to fair value. In this example, it's not applicable because we sold these investments. You look back up at the problem. We sold the investments on January 1st. And we did our entries and had everything recorded as of December 31st. And the next day we sold them for the fair value we had. So we don't need an adjustment for fair value because the bonds are already at fair value. Okay. So no need to do anything else. All right. So step 2, we need to reverse any unrealized gains or losses out of OCI. Okay, that's what we're going to do. So looking at the problem, looking at the information, we know we have $276 in a fair value adjustment account. The other side of that would have been a credit to OCI. So we need to do a reversal of that entry. Okay, so that is going to mean that we need to debit unrealized gains, losses. This is my OCI account for $276, which is the amount I'll show you in just a second if you can't see it right now. And the fair value adjustment. Okay, we're basically just reversing out the what we had put in OCI. So it's this piece right here. Okay, it's the same amount. So it had a debit balance, right? Debit balance because it's not in parentheses. So I want to reverse it out. And I can do the credit, and this is reversing out the OCI, which is really the key. And then step number 3, we're going to remove the general ledger balances. So, looking at our step number 3, whoops, that went crazy. For step number 3, we need to get rid of the clear out the balances and record the sale. All right. So we know we're going to get cash, and we know how much cash we're getting. We're getting $892. So let's go ahead and record the cash because that's always easy. Whoops. We know we're also going to get rid of the discount on bond investment. Okay. I need to move my debit over a little bit. All right. Now go back down. Still need to move you over. And that, if we looked at the discount, would be 108,276. I'm going to finish the entry and I'm going to show you where I got that number. You actually know where I got that number. It is the difference between the face amount and the amortized cost. So I'm going to take the bond off my books. Remember, it was sitting there at face amount. And then the last thing I'm going to do is I'm going to record a gain on the sale. And you know all the gains go through net income, just to keep us thinking on the same page. And that gain is a familiar number, 276. Except I wrote 275, 276. All right, that's going to make the journal entry balance. Okay, so just to make sure you're clear, we got cash of $892. The bond was recorded $1,000,000 face and $108,276. That gave me my amortized cost of $891,724. To make the journal entry balance, I needed a gain on sale, net income right there. All right, so that would be the entry for an available for sale bond. And we talked in class about what would be different if it was a trading security. So let's just run through that real quick. If this had been a trading security, then you would not have done step number 2. It would have gone away. Excuse me. And then in your journal entry, if it was a trading security, rather than this credit to the gain, you would already have the gain. It was sitting in your fair value adjustment you already had recorded, and you would just use this entry to get rid of I can't get it to go away. There we go. Not accountant. Okay, we'll just do that. You know, the fair value adjustment account. That's what would be different. If it's trading. So you see right with the trading, there's nothing in the income statement because you're just getting rid of what's in the fair value adjustment account. Right? All right, so then what would be different if it had been held to maturity? If it had been held to maturity, then, again, rather than, you wouldn't have had a fair value adjustment account. So this bottom line would be gain on sale. And of course, this would not say it would say held to maturity. And the gain on sale would be 276. Trying to get my little cursor over there. 276. So that's what would happen if it was held to maturity. Alrighty. Some little quiz questions. You all should do those. Make sure you understand